Hello guys, welcome back. Welcome to this class. So in the previous videos, we have talked about, first we look at what best trading is, and we looked at the correlation, right? The types of correlation, the why correlation is not enough, right? You should avoid trading just correlation, right? And we also moved into the co-integration, right? Concept of co-integration and why co-integration is better, right? Now we'll be looking at the next topic on this series, right? So like I said, we have discussed co-integration. We have learned that some assets maintain stable relationship over time, but now the big question remains, how do we best traders actually measure this relationship difference between assets, right? How do we measure the relationship difference between assets? And the simple answer is spread, right? And this concept is one of the most important foundation in statistical arbitrage trading, right? Spread is one of the most important aspect or concept, right? So in this video, I'll be explaining, or you will understand what spread actually means. You will understand how spread are formed. You will understand why spread widen and narrow, and why best traders monitor spread very carefully, right? And you need to trust me on this. This is where statistical arbitrage starts becoming even more practical. So what exactly is spread? I'm sure you must have heard it many times. What is spread, right? And this definition here might be different from the one the normal spread, or it might be similar, right? But in best trading, spread is simply or basically the difference between two related assets, right? So let's look at the formula on the screen. You can see that spread is equals to asset A minus asset B, right? Asset could be forex pair, could be crypto pairs, commodities. So the difference between asset A and asset B is what is called spread. And in pairs trading, we are constantly monitoring the relationship distance between assets. That is what we are doing as pairs traders. We are constantly monitoring this relationship difference, right? You need to understand that. And so let's look at a simple visual example. So here is a simple visual example. At first, the two assets are moving closely together, as you can see. So as you can see, the spread remain relatively stable. So this chart is the chart of Coca-Cola and Pepsi, right? So as you can see that at first they are stable. They are moving together at some point, right? But then suddenly at the later the right part of the chart, you can see that one asset becomes stronger than the other, right? Now the distance between the distance between them, these two assets increases, right? And that distance is as the distance increase rather, so we call it spread widening, right? So increased in distance is spread widening, right? You need to pay attention to that. So we'll be using the rubber band effect as an example, and this is the analogy we'll be using again. Remember, I have used the rubber band effect. I've explained it in the co-integration, the last video, right? So imagine two assets connected by a rubber band, right? So as they separate, the rubber band stretches, right? That stretched distance represents the spread, right? And in many statistical stable relationship, the assets eventually move back, right, towards each other again. So it doesn't just stay there, it doesn't just stay stretched, right? They move together, right? That's why it is important to know, to choose the better asset that we are trading, right? Best selection is very, very important, because if you don't choose the proper assets you are trading, you are going to encounter a problem where when they stretched, when this market stretch, when the spread becomes widened, it might not return again. So it will stay stretch and keep stretching until if you are in the trade, you eventually blow up your account. So it is very, very important, right? So spread widening happens when one asset becomes unusually strong and the other one is weak. As this happens, the relationship imbalance increases, and this is where a trader or pest traders needs to start paying attention, right? So the relationship imbalance increase as we have this kind of scenario, right? So spread narrowing. Now let's look at this carefully. After widening, the spread may eventually start narrowing again. Remember, I said the rubber band doesn't stay stretched. If you are trading the proper pair, it doesn't stay stretched. Once it has stretched, it starts narrowing again. The spread may eventually start narrowing again, meaning the relationship becomes normalized. The relation begins to normalize, and the assets move back closer together. And this behavior is closely connected to mean reversion, right? Okay, so you need to understand that this is why spread matters so much in pest trading, right? I don't know if you have heard me say it many times on this channel, that spread matters, co-integration, all the concepts in pest trading matters, right? You need to understand it, right? Spread helps traders to be able to identify imbalance, right? To be able to identify or detect deviation, understand relationship behavior, and measure potential opportunities. And also because pest traders do not or are not only watching price direction, we are studying the relationship, or we are studying price relationship. So these are examples of asset traders may analyze, right? They are assets that I personally trade for spread relationship, because these assets, they often share economic similarity, right? Their relationship can create temporary imbalance, right? So one very important thing to understand is that spread does not remain fixed, right? Spread constantly fluctuates, and sometimes it expands, sometimes it contrasts. So of course, when it expands, that is where we are interested in as pairs trader, so long as we are trading the right pairs. So when the spread expands, we are also using other concepts to back our entry, right? So when it expands, we'll be looking at Z-score, which we'll be discussing later. We'll be looking at mean reversion concept and other tools, right? So when it expands, so long as we are trading the right pairs, we wait for them to contrast, to narrow, right? So I need to understand that it is not fixed. So pairs traders monitors these fluctuations carefully. We monitor it very, very carefully, right? So honestly guys, this is why I always say that pairs traders, we don't trade, but we invest. Our typical trading idea is that we invest. We don't necessarily trade, because we don't chase candles emotionally. We wait patiently for relationship to either narrow or widen, and to become inefficient, right? Now this leads us into a next major concept. How do traders actually measures when this spread deviation become extreme? How do we know that? How do we know when imbalance is statistically unusual, right? Before we take our trade, before we implement our trade, how do we know if we should be taking the trade then at a certain distance in spread? How do we know, right? How do we know if the spread deviation has become extreme? So in the next video, we'll be discussing, or I will explain what Z-score is, and trust me, this is where statistical arbitrage or pairs trading is becoming even more powerful, right? So if you enjoy this breakdown, do well to subscribe and follow the series. We'll soon be through with this, and we enter into even more practical section, right? So remember, I started this series because I wanted to show you how I would trade my last $300. So if all I have is a $300 left with my broker, I'll be trading it with pairs trading. So I'll be talking to you later. Until then, bye.